Hey guys, welcome to another Trade Genius podcast. Got my good friend Bob Kudla here, and we are going to talk about oil and energy and why that may stay elevated for a long time. How does that affect the markets? Well, we're going to talk about that in this video. Let's dive in.
Trade Genius.
So, Bob, it's interesting because the Fed's really in a pickle with inflation. And if the jobs data starts to erode, which looks like with doggy it might, they're really in a pickle because on one hand, they got to fight inflation, which means they don't really want to lower rates. But then typically that's how they fought unemployment as the market softens. And it doesn't look like there's any relief in sight because we're at a weird crossroads with the world's oil supply, aren't we?
Yeah, Phil. And I think it's more than just oil. I think the Fed's in a box, right? We were just talking before the show that with if they can't get oil prices down, they can't get interest rates down, and so we're kind of trapped. And look, we have nobody to blame but the Green New Dealers, right? They basically put a kibosh on exploration around the world, and they're going to reap the whirlwind on this. And people are always ask me why I keep 40% of my portfolio in energy, and this is why. And these charts we're going to show you kind of validates my thinking better than I can illuminate it. And just so happens, ExxonMobil is my biggest position personally, and they wrote a research report out. And you got to remember, ExxonMobil was the second largest oil producer for Russia too. And then when we took Russia out of the oil markets, ExxonMobil lost their position there, and their energy production went down as well. And so what ExxonMobil is saying, and you have to really pay attention to them, is that if we don't continue to invest at a really rapid rate in new production, we're going to be in a situation where oil production is going to be 9 to 10 years ago with current demand, and that means you're going to probably see energy prices spike, Phil, absolutely spike. Now, ExxonMobil is going to be in great shape. Personally, Oxy is going to be probably in good shape. Chevron Oil probably in good shape, and then the oil services companies are going to be in great shape. But the price of oil, if it goes up, there's an absolute great trade for us too. And I'll hold it to the end. I'll get through the rest of these slides here. Is that here's the second slide here? It's showing the peak production at 2027, and then this thing rolls over pretty hard. And even with recessions or depressions or whatever, a lot of the world is still ramping up their oil consumption. So it puts us in a conundrum. And the good news is if Trump could pull off Russia peace with Ukraine, and he could pull off drill baby drill in the United States, they may be able to push that peak production out a couple more years and allow maybe some of these uranium and reactor plays and other efficiencies to come into the picture to keep oil prices from really spiking on us. I want to show you a picture of ExxonMobil. This is amazing, okay? It's like a metronome, Phil. This is a weekly chart, and this is coming out of the collapse from COVID, all right? And look at this grind. And you got to realize, too, during that period here, we're talking, 4 years? They've also paid out, essentially $1 a share dividend quarterly through that whole time, and it's still going up. So, you're looking at, $4, $16, $24 on this. So, basically it's a 50% in the last 5 years on just a nice grind. And, and I have target out on ExxonMobil at like 160, 165, once it breaks over this 120 area again. And I think it's going to get there. And if they can't get oil prices down, there's another stock that it's a high dividend yielding stock called USOY. And I like it a lot because the NAV erosion is going to be fairly negligible, Phil. NAV is the asset value. So when they pay these dividends out really at high yield, sometimes it erodes the value of the shares. Because oil can't go to zero, I mean, it did that one time, but realistically, oil is really in a closed loop system, is that you're going to get a lot of volatility within the ranges, and that's how you get paid on these dividend plays. They're trading the options, they're selling calls, selling puts, and they're generating cash from that. And I own USOY, and it's generating a great yield, and there's no erosion in the stock price, Phil. So guys, there's opportunities here, and the thing that blows me away the most, Phil, we're like repeating 2001 again. And what's hilarious about about this is that in 2001, tech rolled over, and for the next couple of years, it was oil and uranium. I made so much money in oil and uranium in 2002 to 2007. It's repeating itself again. So we may get a situation where tech rolls over hard and we roll into these commodities again. And I'll just sprinkle it with maybe a little rare earth into the picture. And I think you're going to get, these are your plays. And we went ahead and threw a trade on Halliburton today. That's a good trade too. And natural gas is going to be a good trade as well. So not natural gas so much the commodity, but the natural gas drillers are going to do well too. So pick your poison. Always a bull market somewhere, Phil. And you know what, guys? And if you hate all of this, you can just go into 30-day, 90-day cash and get 4.75% for your money and take a vacation and come back in 2 years.
Yeah, I agree. It's definitely raise cash season. And, if they do hold rates, even in the advent of a spiking unemployment, it would be a bit unprecedented. But, things have been pretty weird the last couple of years. So, but that also would make raising cash a great idea. And you don't have to worry about being short the market or anything like that. You're just exiting and getting paid a pretty good yield in the meantime. But I think it's going to be a tough road ahead. I think 2025, I think it comes down to which quarter do we put a top in? Maybe the top is already in. We're looking very bearish in the markets right now with that close today was not good. And if we dive deep enough down, you start getting into a bearish look on the market where you have to start looking at, okay, now we're starting to trend under some big moving averages. If we're holding under the weekly 9 EMA, for example, that's never a good thing, especially if that thing starts to curl down. That's typically when you start to roll over. So bulls are in trouble for sure. They need to do some quick work and get back to those highs. But I don't know, Bob. I think seasonally it looks like we're going to probably be down into the middle of March. The only hope at that point bulls have would be to rally hard, maybe come back up to clean up maybe that double top that we have in some of the indices. But otherwise, that might be it. You might have seen the top in the last few weeks be put into this market, and then you have, typical things that you're going to see going into the recession, such as initial claims spiking, unemployment spiking towards 5%, and then the yield curve normalization starts to get past that 0.6 level, which it's been holding off. So you've had some room to have a bull market and keep pushing up, but the window's closing rather quickly on all of that.
Yeah, I'm sticking with that thesis too, Phil. In 2001, we had a surge in the early first quarter, and then we made a all-time high in the second quarter, and then we fell for a couple of years. So it seems like that fractal is in play here. It's just amazing how things repeat themselves. And I agree with you. I mean, I think tomorrow, if you and I don't get too busy, we're going to do one on the collapse of the consumer, and some of these stock prices of some of these consumer names are getting absolutely obliterated. So for us, we don't really care. We love the volatility. That's how we make money. And I think we have now winners and losers that we can run with. So a lot of people in the room ask me all the time, should I be pairing my energy position? And I'm like, no. Yeah, I would stay with a pretty high allocation. Prices really will have to fall under $60 for me to get pulled off of some of my positions here, Phil. But anyway, I'll let you guys go. Come trade with us, guys. We're having this last week, when the market rolls over, Phil and I could be complaining for weeks about it not rolling over, but when it rolls over, you make all your money in a really short period of time. And we're in that window right now. So come trade with us. We'll catch this bottom too, and it'll be a great reverb rally that we'll be able to run with too. And look, we don't have to look out too far in the future. We can just look for the trades right in front of us. Thanks, Phil, for everything. I'll catch you guys later.
Trade Genius.